When the Fed admits the truth, you know something serious is going on. There is an absolute fact that is denied by the financial analysts and so-called experts everywhere. Every single time the Fed increased interest rates, a recession followed. Don't worry though, this time is different. You came here for the truth, so let me unveil that for you. Let's take a look at what the Fed said this time around, beginning with the president of the Dallas Fed, Robert Kaplan. I'm going to show you some quotes from what he said to give us an idea of what will happen in 2018. First of all, the Fed funds rate saying they left it unchanged at this range of 125 to 150 basis points, basically rock bottom if you take a picture of where they were in 1980, and they simply have been on this trajectory downward. And all along the way, if you were to take this chart and look at it more closely, you would see periods where the interest rates, the Fed funds rate, were increased. But if you look at it on a larger scale, every time they do so, a recession occurs 100% of the time. And so what will they do this time around, where they've increased them in the smallest little steps they can do? Surely this will cause a problem and they will have to bring them down yet again. It is a fact. You can't get the interest rates to go very high this time around. And they have increased it marginally, as I've said. And unfortunately, it's going to present them with a problem in the near future. In this here, you can see that Kaplan suggests that they must increase interest rates before it is too late. And of course, they're always too late every single time. I've concluded that looking at the history, every single time they are too late and they increase too slowly. This is just one example. We're in it today. So they make a couple claims here, a couple lies. The economy is going to grow at 2.5 to 2.75% in 2018. Apparently, there's a healthy jobs market, and there will be improvements in household balance sheets. That's total lies here, but we hear that all the time, of course. And they also talk about the labor market. It's going to go from 4.1%, not true, to 3.6% by year end. Imagine how many people have fallen off of the statistics because of that number. Now you can look at the U6 and get a more realistic picture. It's not fully accurate, but I do believe that at least it's a BLS reported number. Anybody could see it. We don't need it to be recalculated by John Williams. Okay, we can just go to the BLS, see their statistic. All right. And it's almost as if they don't like to talk about the U6 and think that it is, not significant. All right. Claiming that it is at 8.2%, going to below 8%. But when you think about it, 8%, that's a real unemployment rate of 8%. That's still very high. But they use the U3, obviously it makes it look better. So why wouldn't they? If they can get away with that. I mean, why don't they just create the U1? Why not the U-5? Like, why ever create a realistic number that people would actually get a real idea of what the economy was, progressing, how it was progressing, how it's doing? Of course not. All right. Now, you can see here they're talking about their 2% longer run inflation target, talking about their silliness along the way, and ultimately here, based on the expectations, I believe the Federal Reserve should be gradually and patiently raising the federal funds rate during 2018. So he's saying during 2018, we need to see those rates. Don't go crazy with it, but we need to see those rate increases. While my views of the appropriate path of policy will be impacted by economic conditions as they unfold during the year, I continue to believe that gradual and patient removals of accommodation will increase the likelihood of extending the economic expansion in the US. He just said that if they increase interest rates and if they decrease their balance sheet, that somehow that's going to increase the economic conditions. Now, I don't know where they get that. Think about this for a second. The threat of increasing interest rates in the US brought the market down at one point by 1,600 points. The threat of it. What happens if they actually do? They've been increasing, and the slowest potential they've done over these, course of a 10-year period. Think about it. Basically a 10-year period. They've increased interest rates maybe 1.25%, depending on how you want to look at it. 1.25%. It's basically nothing. It's insignificant. Historically near the bottom. History suggests that if the Fed waits too long to remove accommodation at this stage in the economic cycle, excesses and imbalances begin to build. He's speaking of it as it's, a historical thing that's gone on. What about what's happening right now? They're waiting too long. Ultimately, the Fed has to play catch up, in my judgment. Getting behind the curve and then trying to catch up would increase the likelihood of a recession in the US. That's exactly what I just said. Exactly. It's good to know that Kaplan and I are on the same page. He's just ignoring what they're seeing today. Somehow can't see the forest from the trees, as they say. So I'm going to just cover a few things very quickly. Want to go through these. I really just wanted to get into the Fed, but I had all this information. I put it all together into one. So let's go through it quickly and concisely. U.S. debt to GDP. Somehow we've went this territory under Obama. You've seen it before under Bush and under Clinton and everybody else. Debt just continues to rise. Doesn't matter which person will be in charge. Ultimately, there has to be more deficits. There has to be more debt. The system is designed that way, and the central banks will make sure that that continues. It is a policy that is applied at the central bank level. Why? Because that's how new money is generated. It's actually generated in debt, which is such a strange way to develop a system, but it works for them. So they are able to control everyone. Now, this happens to be the Barclays High Yield Bond ETF. You're looking at this as it's basically incurring some outflows here at the time we are seeing the sales, and that's not normal during this time frame. Chart of the week, bond ETF sales amid rising rates. Rising rates, right? If you look at the Fed funds rate, which is basically the core of the rates, and you see it being so small, what would happen if they were to go from this level of 1.25 to 1.5 to a range of 2.5 to 3? Still, historically, very low. You would have such a big problem, and the market can never withstand that. Imagine what mortgage rates would be at if the Fed funds rate is at 3%. I'm excited to see what happens. Now, you could see this net buys of fixed income ETFs versus the 10-year yield. Guess what? Coming down. That's not a good sign at this time, not just for this particular investment as it is, but when you see bonds, which are supposed to be this safe haven, supposed to be fixed income people when they're worried about equities, they can always go to bonds. And I don't think that's the case here now, because you can see around the world, they are ultimately seen as more risky these days. More money is flowing into equities because they believe that the central banks will be there to buy shares. Something really wacky is going on at this time. I don't know what's going to happen with bonds, but there have been many analysts, there have been many people, there have been all kinds of indicators pointed to the fact that bonds are going to collapse. It's going to be a huge issue. It's a much bigger market than equities as well, and it has that domino effect. It's not a good thing when you see this. Average tax refund in every state. I thought this would be interesting for those living in the US, your particular state, if you wanted to see this. This is from that great website, How Much. I've covered from this website before. You can see for yourself if you're interested. Obviously, based on the color here, determines the amount. And you're looking at Texas being one of the greater ones here. And then this, I almost didn't want to mention it, but I'll just quickly talk about it. Venezuelans report big weight losses in 2017 as hunger hits. Now, the average person apparently has lost 24 pounds in body weight, and 90% now live in poverty. I don't know if that's a real statistic. I don't know, what you're basing that on, but let's say it's not 90, let's say it's 80, let's say it's 75, let's say it's 70, it doesn't matter. The crisis continues to get worse. And what's happening? Nothing positive. They released the petro. The petro. What a joke. It has zero value. Zero value. And that's not a good sign. I'm sure it costs money to set that up. So they're actually in the hole even more at this time. This is just, it's sad to see anyway. So one of the things that I want to mention here, to go back to the beginning, the Federal Reserve. I've talked about it ad nauseum, but as time goes on, you will see throughout 2018 here, you're going to see the markets becoming less willing to deal with the interest rate hikes as they start to come up. And all you need to do is pick up the books, the history books, and read about what happened last time. 95% of the people either have amnesia or they never invested during these previous crashes. They didn't know what happened. And so they're unsure and they just go with whatever it is they believe. If they're invested, surely they want to believe that everything's going to be fine this time around. 100% of the time, 100% of the time, interest rates increase, market crashes. It is an inevitable fact. It's going to have to happen. And then many people would say they can't increase interest rates, so they'll stay low. But that's not how it works. They don't realize it until it's too late. And then they start bringing the interest rates down and down and down. But by that time, it's already affected. You've already had this domino effect, this snowball effect. It starts to bring down this market and that market and exposes those cracks. And suddenly they panic. They're bringing the interest rates down. They're printing money, the TARP bailouts and everything else. And then you're seeing the panic ensue. You're seeing companies go out of business. And then suddenly, okay, that company and that company, this company is suing them. Mergers and acquisitions are happening in a desperate attempt. There's bailouts of all kinds. That's the way it works. It's not orderly. People somehow believe it, that there are things that are orderly. No, that's not the way it works. It just simply will not happen like that. And that's all I'll say. If you found the video informative, please give me a thumbs up. Last but not least, if you found this video informative, I know you'll find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. You can flip through these books at Amazon. The first book is about the 4 asset classes and how to profit from it. Whereas my newer book, I talk about familiar subjects, but I also get into earning income, tax incentives, reducing your monthly expenses, and so much more. So check those out at the links in the description of this video. That's all. Take care.